Okay, welcome back everyone to our weekly options education webinar series. Today we're going to be talking about generating consistent income with weekly options by selling covered calls. This is a topic that's generally speaking more so for those of you that are starting out with options, but for those of you that are experienced with trading options, this is a strategy that's really useful for everyone, whether you're brand new to options trading or a very experienced options trader. As long as you own stocks, ETFs, or any type of equity in your portfolio, you should be considering selling cover calls against that position to generate some additional yield for your portfolio. So today we're going to be talking about the concept of this strategy for those of you that are brand new. I hope to bring a little different spin to this to make sure that you understand how to view this strategy, because I think there's some misconceptions about selling cover calls. So I want to bring a different comparison here, which is primarily selling your stock at a higher price to selling cover calls. And then what we'll do is we'll go over how to actually go about selecting cover calls. What should you be looking for in terms of expiration date? What should you be looking for in terms of strike prices? And then lastly, how do you actually evaluate, am I getting enough yield for the cover calls that I'm selling from my portfolio? So those are some of the things we're going to cover. This webinar is recorded. I will produce the slides and send that to everyone once we're done with the recording, so that you'll receive both the webinar recording and the slides so that you can follow along if this is your first time. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. We're going to spend about 20 minutes going through the slides, going over best practices and what to look for when you're selling covered calls. And then what I'll do is the second half of the webinar, we're actually going to show you some real examples using Options Play. And the goal there is to make sure that you understand not only the concepts, but more importantly, how to apply it to your specific portfolio, and making sure you know how to utilize the tools that we have here at Options Play to apply what you've learned here today. The last thing I want you to do is learn something and then not be able to apply it when you're actually going to go trade them. We want to make sure that you have a practical application of what you learned here today. And that's the most important piece. So if you're brand new, welcome to Options Play. We do these webinars every single Thursday to make sure that you learn about different options trading strategies and, more importantly, how to deploy them using Options Play. And for those of you that have been to our webinars before, welcome back. Let's go ahead and get started here. So I just have a little bit of housekeeping before we get started here. Number one, I just want to, for those of you that are brand new and have never used Options Play, please go to optionsplay.com to sign up for a free 30-day trial. For those of you that are on a free trial, please subscribe. It'll give you a wealth of knowledge in terms of having access to all of our webinars, as well as access to the platform that we'll be showing you guys here today. And lastly, there are some very important links. So for those of you that are looking for other forms of education with respect to option strategies, I highly recommend you to take a look at the weekly options education webinar series. We have the recordings available to everyone. We have daily trade ideas that we send out. And most importantly, I think those of you that are looking to learn about options, I highly recommend you to take a look at the Options Industry Council. It's a free resource available to everyone. It has a wealth of knowledge with respect to options education. So especially if there's anything here on this webinar that perhaps you want to learn more about, or some of the terms that we're talking about, perhaps you don't understand them, go to the Options Industry Council. They have a great resource there to help you get started with options education. So with that, here's the things that I want to go over here. Number one, what is a cover call for those of you that are brand new to this strategy? Like I said, even if you have traded cover calls before, I'm hoping to bring a different light to kind of how you view cover calls today. So hopefully, even if you do trade cover calls, you learn something new. Then we'll talk about why you should utilize cover calls. What are the benefits? What will you actually achieve by selling cover calls? Then, once we kind of understand the concept of the strategy and why we want to do it, I want to cover what our best practice is when it comes to selecting expiration date and strike price. This is where I see most beginners tend to struggle, is figuring out where is the right expiration and strike price to start with. So we'll talk about what to look out for when you're selecting expiration dates and strike prices. But most importantly, what I want to show you is actually how options play automates this for you. As much as I want to teach, at the end of the day, the most important thing is that you actually have the tools to implement what we're teaching. So that's why we want to show you how to implement it using options play, which automates everything that we're going to show you here today. And lastly, once you're in a cover call, we do want to make sure that you understand how to manage those cover calls once you're in them. So we'll wrap this up by talking about some exit strategies. Okay. So with that, I'm just going to jump right into it. We're going to talk about what is a cover call. Actually, before I do that, I just want to do a quick poll here. How many of you have traded a cover call before? Please answer the poll on the screen just so I get a sense for the audience here in the room. Okay, so about 2/3 of you have traded cover calls. A third of you are just learning about it. Great, so I think that's a very healthy balance here. For those of you that have traded cover calls, we'll go over best practices and tips for how to go about doing so and selecting the correct expiration date and strike price. For those of you that are just learning, welcome. I really hope that this inspires you not only to look at the strategy, but also see how options play makes this process of selling cover calls as easy as possible, because this is usually the first strategy you trade when you start trading options. So for those of you that are new to cover calls, I really hope that this kind of inspires you to take a look at options as an alternative for your portfolio. So that's just the quick results here. As you can see, 68% of you said you have traded cover calls, 32% of you are just learning about it. So great. So today we're going to be talking about what is a cover call. Cover calls are really simple. It takes your existing stock position with where you need at least 100 shares minimum. So this is think about the existing stocks that you have in your portfolio, stocks or ETFs, any of them that you own with more than 100 shares. What a cover call allows you to do is to sell a call option against the stock that you own in your account. And that is what we consider a cover call. Now, we're going to go a little bit more in depth into this just to give you an understanding as to why you want to sell a cover call. I'm going to give you an example, and I think that's going to help drive the point home as to what is actually a cover call supposed to do for your portfolio. So what I want you to do is I want you to first imagine that you have 100 shares of Apple, and let's say you own 100 shares of Apple at $170. So the current price of Apple is just around 170. So let's say you buy 100 shares of Apple at 170, and let's say you have a target price of 185. You think the stock's going to rise, right? That's why you buy the stock. You think it's going to rise in value. So what I want to display is two possibilities that you can go about applying to your portfolio that achieves this outlook, meaning you buy the stock, you think it's going to go higher. How do you actually go about doing this? There's two ways effectively that you can play this out. Number one, you can buy the 100 shares of Apple at 170, and then you can put in a limit order to sell your stock at 185. And what you do is you wait for the stock to rise, and if it goes up to 185, you're able to sell your stock at a $15 profit, the difference between 185 and 170. What I'm proposing is an alternative to that. You can sell a January 185 strike cover call, and let's say you collect $3 on that cover call. So now what this allows you to do is effectively do very similar things, because when you sell a call option, you have the obligation to sell the stock at the strike price that you've chosen. So if you sell a 185 strike cover call and the stock goes above 185, then you're obligated to sell your stock at 185. Very similar to placing a limit order at a specific price. So if the stock hits that limit order, you will exit that trade. However, the difference here is that with one side of the equation, you get paid to put in this order. So by selling a cover call, you're providing the obligation to sell the stock at 185, which is your target price, but someone's going to pay you some money to do so. And that's the best way to think about selling a cover call. It's like placing a limit order to sell your stock at a higher price, but someone paying you to do so. And that payment that someone's giving you is the income that you receive on a cover call. So let's take a look at these two scenarios and see what the difference is. So number one, what I want to talk about is risk. What is your risk with each one of these two strategies? If you bought the stock at 170, your risk is 170, meaning if the stock goes all the way down to zero, you will risk $170 a share or $17,000 for the whole trade. When you sell a cover call, your risk is reduced by the income that you receive. So instead of risking 170, you're now only risking 167. So $3 less. Not a whole lot if the stock goes to zero. You're not missing out. You're not making that much more money. However, or you're not losing that much less money. However, it is less money that you are losing. So by selling a cover call, you are reducing the risk of your portfolio. On the upside, if the stock does rise to 185, here on the cover call side, you're going to make more money per share because now instead of making $15 a share, you're going to make $18 a share because you've now collected $3 on the cover call. If you just sell the stock at 185 with a limit order, you're only going to make $15 a share because the difference between 170 and 185 is 15 cents a share. So number one, you have more risk if you just enter a sell limit order, and you also have less reward if you just enter a sell limit order. So right off the bat, cover calls looks to be coming out ahead between these two strategies. Third of all, when are these strategies profitable? If you buy the stock at 170, it's only profitable if the stock goes above 170. So I think that's pretty clear. But like we said before, because you're collecting some premium on the cover call side, you've now lowered your break-even price. So the stock actually, even if it moves down a little, you're still going to be profitable on this trade. So this is really some of the better alternatives to just outright selling the stock. And lastly, the thing to look out for or compare is that when you sell when you buy the stock at 170 and you sell it for 100 shares, your exposure is until the stock rises to 185. You sell a cover call, your exposure is only until the expiration date, meaning that you only maintain this exposure until the expiration date, and afterwards, you're actually able to sell another cover call. And that's where we can generate consistent income on your portfolio, because you're not just doing this once, you can do it over and over again. Now, some people will tell me that, well, what if I don't have a target price of 185? What if I have a target price of 300 on Apple? How should I still sell cover calls? I'm still going to be able to sell my call. I might end up selling my shares at 185 when I think the stock's going to go to 300 or 500. And I think the best way to think about that is if you think the stock's going to go to 500, chances are you don't think it's going to go to 500 by next month. However, when I talk about a target price, we're only talking about a target price between now and the expiration date. So when you select a strike price, it's only your target between now and that expiration date. So if we're looking at January, we're only looking 1 month out. Are you okay with a $15 profit on this trade in 1 month? Chances are you should be. Because most of the time, if it does hit your target price on a cover call within 1 month time span, that usually annualizes to a pretty high rate of return. Hello? Sorry, looks like I got cut off there. Can everyone hear me? I apologize there. Sorry about that. Looks like my internet got cut off there. So like I said, I think the best way to think about this strategy is to think about comparing this to selling the stock with a limit order. And again, when I talk about a target price, I'm not necessarily referring to your long-term target price on the stock as a fundamental buyer of a stock, but think about your target price in the very short term, meaning would you be okay with a $15 profit in a 1 month time span on the stock? Chances are you will be, because that's a fairly good annualized return. And that's the best way to go about thinking about when you're selling a cover call is what is your short-term goal, or what is your short-term target profit? And if you're okay with selling your shares at that price, that is really how you should go about thinking about selling a cover call. So why should you sell cover calls? So number one, like I said, the best way to think about this is exiting your stock at a profit, but generating some income to do so. So putting a limit order to sell your stock at a higher price at a profit, and being able to generate some income by placing that order. That is the way I think is the best way to think about why you should utilize a cover call for your portfolio. Now, what this does is it lowers the net cost basis of your stock. Like I said, we reduce your risk by lowering your cost basis on the stock, which also translates into higher rewards when it does hit your take profit prices. And the best part, as far as I'm concerned, is that it's used on the existing stocks in your portfolio, meaning you don't have to add any additional risk to your portfolio to generate income. This is the only strategy that you can deploy using options that generates income without adding additional risk to your portfolio. Meaning all this does is actually reduces risk of your portfolio, because by generating income, you're reducing the cost basis and the net risk of your positions and your higher rewards, and you get some income to do so. So those are some of the benefits of why I think you should look at selling cover calls. The limitations is that it does limit the upside return of your stock. So if you buy Apple stock at 170 and you think it's going to go to 500, you might end up selling your stock at 185. Like I said, that is the risk that you take. However, most people should be okay taking that kind of risk, because you're talking about a $15 return, roughly a 10% return in a 1 month time span. That's usually a very good annualized return. And I think most people should be happy taking those types of returns. The only thing is that it requires at least 100 shares of your stock, and it does risk you do have the risk of selling that stock. So those are some of the limitations of selling cover calls. But like I said, you have to think about it in the sense of what are your short-term targets of the stock, and are you okay with selling your stock at a fairly nice profit in the very short term? So now that we've talked about what cover calls are, how to, what are the mechanics and what are the benefits, now let's actually go into the nitty-gritty of selecting expiration date and strike price. So when it comes to selecting expiration dates, it's fairly straightforward, because when you sell a relatively short dated option, an option that expires relatively quickly, you have quite a bit of certainty in terms of what is likely going to happen between now and expiration. What I mean by that is things that typically move stocks a lot, like corporate earnings events, dividends, product announcements, things like that. These types of things you generally have some bit of visibility into if you're selling 1 month out. Versus if you sell a 6-month option, you have a lot less certainty as to what's actually going to happen. So what you get is less income if you have a short dated option, versus more income if you have a long dated option. So a lot of people will ask, well, why wouldn't you just want more income? Well, the answer is not that simple. What I usually tell users is to select a cover call based on how frequently you have time to trade. So if you're an active trader, you definitely want to stick to more short-term expirations, so anywhere from 21 to 49 days out. Those are the weekly options that we're talking about, 3 to 7 weeks out. That's where you want to take a look at if you're a short-term trader. If you're a long-term buy and hold investor, meaning you look at your portfolio once a quarter, I wouldn't recommend that you sell weekly options, because you simply may not have enough time to manage those things or manage every single expiration cycle. So you do want to sell longer dated options. And then some of you will be somewhere in between. This is where you want to sell monthly options. 1 to 2 month options is usually a good starting point for those of you that are casual investors, that you're not buying and you're not trading very actively. So what I want to do is actually break down what you actually get for each one of these timeframes, and why we feel, based on our research, that it's better to be more on the shorter end of the spectrum. So if you have the ability to trade the weekly options anywhere from 3 to 7 weeks out, we recommend that you try to take more certainty in your trades. And the reason for this is because by avoiding selling calls during earnings, that's how you improve the returns of this strategy. Now, when you sell short dated calls, so when you sell a 1 month call, you can do that 12 times a year. And we know that there's 4 earning cycles every single year. So 25% of the calls that you sell have this large uncertainty factor built into it. If you're selling 3-month calls, you can only do that 4 times a year, which means that every single call you sell has this large uncertainty factor built into it. So because of that, what we suggest is that you sell short dated options, so 1 month calls. You can do that actually by avoiding the 4 times a year where earnings are coming out, and only do this 8 times per year and actually avoid all the times that you sell cover calls. And the second reason that we suggest that you focus more so on the short end of the spectrum is that premium is not linear to time. What do I mean by that? When you sell a 1 month call, and let's say you get $1 for that 1 month call, when you go out 3 months, you're not going to get paid $3 for that 3-month call. You're only going to get roughly 2 times that. So even though you're going 3 times out in time, you're not going to get paid 3 times as much, which is why we recommend you can do a 1 month call twice and receive roughly the same amount of income as someone who sold a 3-month call. What that means is that you can sell 2-month calls, skip the 3rd month when earnings is coming up, and resume again after earnings and get roughly the same amount of premium without the risk of that stock moving substantially higher or lower during earnings. So that's really why we generally suggest that you focus more so on the short end of the spectrum when it comes to selling cover calls and selecting expiration dates. When it comes to strike prices, this is really where I tend to see that a lot of people use their emotions to select a strike price as opposed to specific numbers. And this is really where I have to advocate for a specific way of going about selecting strike prices. So before we talk about which one's best, let me just want to make sure everyone understands the relationship. When you sell a strike price with a higher strike price, that just means that you're giving your stock more upside. So the higher the strike price, the more upside you're giving. So when you place a limit order on that Apple stock, instead of 185, you can choose 190 or 200. So the higher the strike, the more the stock needs to go before the stock gets called away, and that results in less income. So those are some of the things to keep out for, or to look out for when you're selecting your strike prices. Alternatively, you can also select relatively low strike prices near the current price. This gives your stock a lot less upside, but this translates to more income. So what I tend to find is that a lot of people will prioritize this more income thing because they're just searching, because when you're selling for a cover call, you want income, right? So people tend to lean more to the aggressive side of things and try to generate more income. But that comes at the expense of lowering the stock upside, which means that you're not going to be able to get as much participation in the upside of the stock. And this is really where you want to select your cover calls based on your risk tolerance. So if you're conservative, that means that you really don't want to sell your stock. You want to keep your stock. For those of you that, maybe you have some stock that you own because you've had for a long time and you don't want to get rid of it because you have a low cost basis on the stock, or perhaps you have some stock that you rely on the dividends for income, you would fall into the conservative end of the spectrum. You want to choose roughly a 10 delta call, or a call that has about a 90% probability of that call expiring worthless. Now, if you're saying, how do I calculate that? Options Play actually does it for you. So, and we'll also help you select them. So not only do you have to not worry about calculating it, we'll actually go and find these for you. You just have to make sure you understand which one of these 3 categories you fall under. The aggressive side is for those of you that are really trying to chase as much yield as possible. You don't mind having your stock called away. You just want to maximize your income. For those of you, you want to choose roughly a 30 delta call, or a 70% probability of that call expiring worthless, or about a 30% chance that your stock gets called away. And most of you will fall somewhere in between, such as myself. I would consider myself more on the optimal end of the spectrum. I would select roughly about a 20 delta call, or something that has roughly about an 80% chance of that call expiring worthless. So that's how you would go about selecting your strike selection. So what we did is we back tested these strikes, and we wanted to give you an idea as far as where we saw the largest performance. And the answer is more upside. More on the conservative end of the spectrum is where you're going to get better returns. That might sound counterintuitive. However, the reason for this is because this is a negative risk to reward strategy, because what you collect on the premium on a covered call is limited to what you collect. However, the lost opportunity is unlimited. What do I mean by that? When you sell your stock at 185, the stock can shoot up to 190, 200, 250. However, what you've done is you've sold your stock at 185. So the lost opportunity above 185 is unlimited. And what you want to do is you want to minimize that, because that offsets any income that you've received. So in order to do that, the only way to do that is by providing your stock more upside, so that the income that you receive does not go offset the lost opportunity that you have above the strike price. And this is really important. And think about it. When you own a stock, or if you buy a stock at 170, why do you buy that stock at 170? It's because you think the stock's going to go higher. So it doesn't make sense to limit how much you can make on that stock, which is primarily where most of the risk is. It doesn't make sense to limit that potential reward just to collect an extra 20, 30, or 40 cents on a cover call. That's a very short-sighted way of thinking. So the best thing to think about is the underlying shares, not how much income that you receive. So that's the best advice that I can give to you when you're selecting your strike prices, is don't just go try and chasing yield. Think about how much upside return you have for the stock, because that's primarily where your risk is. So now that if we looked at, choosing an expiration date, choosing a strike price, once you go about doing that, now that you've selected an expiration date and strike price, how do you know if you're getting enough income? So the easy answer here is actually quite simple. You just want to compare the cover call yield on the cover call that you sold to the dividend yield of the stock that you're selling the cover calls on. Now, if you're asking how do I calculate cover call yields, Options Play actually does all the calculations for you. You just have to compare it to the dividend yield and get a sense for whether or not you're getting enough income. So the rule of thumb here is usually you want to beat the dividend yield with your cover call. That's how you determine whether a cover call is worth taking the risk or not. So I have three examples here. If you have a stock that you are paying a 3%, that pays you a 1% dividend, and you're looking at a cover call that's yielding you 3%, that is the type of ideal situation that you're looking for, because you're increasing your yield from 1% to 4% overall by adding this cover call. The second scenario is you have a stock that pays a 3% cover call yield on a stock that already pays you a 3% dividend yield. This is kind of your minimum threshold, meaning you want to at least beat the dividend. That's the bare minimum that you want to meet. And lastly, if you have an example where you have a stock that pays a 3% dividend, but only pays you 1% on the cover call, that's an example of a trade that you may want to avoid, because you're just simply not getting enough yield, not getting enough income for the risk that you're going to be taking of losing that stock at a price, losing that stock effectively. So that's how you go about determining whether you're getting enough income. So with that, just to sum up everything, in terms of back-tested cover call results, in terms of selecting an expiration date, you definitely want to focus more so on the short term, because of what we talked about, the fact that short-term options really allow you to maximize time decay, which is working in your favor when you're selling a cover call. When you're selecting a strike price, really selecting a roughly 15 to 20 delta, roughly a 15 delta cover call is a good starting point, somewhere between optimal and conservative. And lastly, for performance, what you can typically expect for these types of strategies is about a 3.5% annualized return on top of what you're getting on your underlying stocks. So that's just a quick summary of what to expect if you follow this type of methodology. So now what I want to actually show you, most importantly, is how to actually go about doing everything that we just taught you on Options Play within a few seconds. And the goal here is to make your life as easy as possible. So when you use Options Play, for those of you that are brand new, you'll see that the platform is divided into 3 sections. We have trade ideas and watch list on the left. We have our security analysis panel here in the middle. And lastly, trading and income here on the right. These 3 panels represent the what, the why, and the how of options trading. So let's start off by looking at the income tab today, because that's where we're going to focus our attention on, is selling cover calls, which falls under the income tab. And before we do anything in the income tab, there's a button here at the bottom that says income settings. It's very important that you click on that and set your personalized settings, because each one of us has different frequency of trading. We all have different risk tolerances. It's important to set those risk tolerances based on your personalized settings. So I will be an active trader because I have time to look at my account every single day. For risk tolerance, I'm somewhere between conservative and optimal. So I usually select optimal for cover calls. And you can actually, for those of you that are more experienced in selling short puts, you can actually set these independently of each other for cover calls and short puts, so that you can actually do all of these at once. So you can set cover calls and short puts, and all you have to do is save this as default. And what happens is Options Play will actually go out and search the whole option chain and return back to you the cover call and short put that meets your personalized criteria. So this is compared to using a page that looks like this. If you've ever used an options chain before, I think you'll know that this sometimes is a bit overwhelming in terms of figuring out where to start, what expiration to choose, what strike price, and let alone once you've selected all of those things, you still have to figure out, is there enough income on this? Many times you have to calculate yields manually. So what we're trying to do is avoid all of that and just doing all that work for you, so that all you have to do is simply type in a stock, and we will actually go out and search the market for all the expiration and strike prices and return back to you your optimal starting point. So for Microsoft, that's trading at 109.45. This is telling me to take a look at the January 4th 115 cover call. So a call that's about $5.50 above the current price. So basically what I'm saying is that I've set a target price of 115 over the next 22 days. So a $5 move over the next 22 days, that's roughly about a 4% move in 23 days. That annualizes out to be quite a high number, much higher than any returns that you would get on an average return from a stock. So what that means is that you're basically buying the stock and you're putting in a limit order to sell the stock at 115 that expires on January 4th. And in doing so, you're going to collect $71 in premium. That comes out to be an annualized return of 10% just on the cover call alone. If you own Microsoft stock, you only get paid 1.69% dividends. So relatively low dividend yield for a large cap name, but you can add an additional 10% on top of that by selling a cover call. That's why you want to consider looking at these types of strategies, because it allows you to generate some additional yield on the stocks that you already own. And if the stock really does rally significantly, you're able to take profit on that rally. That is the benefit of selling cover calls for your portfolio. Now, what I want to show you is how easy it is for someone to be able to look at a whole portfolio, and within few seconds, without ever having to pull up an option chain, you can know exactly if there's a cover call opportunity on the stocks that you own or not within just a few seconds. So we're looking at Netflix trading at 276. Now, what we want to see is what cover call can we sell? So on the income tab, it'll ask you, do you own shares of Netflix? You can type yes. You can even enter the number of shares. So let's say you own 200 shares of Netflix. Now it will tell you that you can sell 2 contracts of the January 4th 302.5 cover calls. The stock's trading at 276. So this is roughly about $30 above the current price. So basically you're saying that the stock can rally $30 in the next 22 days. And if it does that, I'm able to take profit. Otherwise, you collect $520 in income. On a stock that pays you 0% dividends, you're adding an additional 15% yield to that portfolio because you're collecting $520. And for those of you that are brand new, we break this trade down into plain English for you so that you have a better understanding of exactly what you're doing and what the stock needs to do in order for this strategy to be profitable. And this is really key. And what we want to do is make this user experience as easy as possible so that you can just create a watch list with all the stocks that you own, Put in the income settings here at the bottom of the income tab so that you've created your personalized settings. And all you have to do is click on each individual symbol to be seen so that we can show you what is an optimal cover call to sell. So here's Facebook trading at 145. If any of you own the stock, you may be underwater on the stock because you may have purchased it at a higher price. So here's an opportunity to recuperate some of those gains and some of those losses. So you can earn $90 per 100 shares over the next 22 days. So imagine reducing your cost basis by roughly $1 over the next 22 days by selling a cover call that's $10 higher above the current price. This is basically saying that if Facebook rallies $10 in 22 days, that probably annualizes out to a fairly large return to be able to let you do that very, very quickly with options play. So I just want to go through a few more examples here, and I just want to show you how easy it is to use options play to quickly gauge a cover call opportunity. So Apple's trading at 170. Let's take a look. You can sell a January 4th 182.5 cover call, so $12.5 above the current price, generates a 9.6% yield on a stock that only pays a 1.7% dividend yield. So you're going to increase your yield from 1.7 to 11.34. So imagine if you can increase the yields on all the stocks in your portfolio. What does that translate to in terms of income? It can be a substantial amount. And that's really why you want to utilize this strategy to help you generate some yields and potentially take profit on some of the stocks that you own, because you already own these stocks. They're just sitting in your account. They're generating some yield if they're paying a dividend. Some of them don't pay a dividend, but it's really important that you take a look at selling cover calls to add additional yield that you wouldn't receive from the stocks that you already own in your account. And that's really why I think this is such a compelling strategy to look at if you're a stock investor, because you already own these stocks. Here's an opportunity to extract some additional yield from the assets that you already own without adding additional risk. You're actually reducing risk of your portfolio. Let's just take a look at a few more examples. IBM trading at 120. Taking a look at cover calls here, this is telling you to look at the January 4th 126 cover call. So about $5 above the current price, generating a 9.3% yield on a stock that pays a very hefty 5% dividend. So if you own IBM stock, this is probably one of the highest Dow Jones dividends, probably aside from stocks like AT&T, but you can add an additional 9% to that. So bringing your total yield to 14%. Imagine if your IBM stock was yielding you 14% instead of 5%. Is that something that's attractive to you? I think for most people that is. So this is really why I think you should consider taking a look at selling cover calls. And options play is here to make that process as easy and as efficient as possible, because you can go through a list of stocks within a few seconds, know exactly whether there's a cover call opportunity or not. So on Intel, selling a 51 cover call on a stock that's trading $48 over the next 22 days. This instantly tells you where to start, and you never have to pull up an option chain. You never have to scroll through pages and pages of this. And best of all, a lot of times you go through pages and pages of that, and then you find out there's no cover call to sell. Maybe there's not enough premium or there's no expirations available. We do all of the work for you so that if there's no cover call available to sell, you get a message that looks like this. So notice how on Ford it looks a little different. Now you get a little red warning sign. It's telling you that we couldn't find you a short-term optimal call. We found you a short-term aggressive, which is the next best alternative. So for those of you that are brand new, just ignore these and move on. You don't have to spend more time on finding a cover call in Ford. We're basically telling you we couldn't find you one. Move on. This is designed to save you as much time as possible so that you're not wasting your time going through pages and pages of option chains to try to figure out where's your ideal starting point. And when you do this stuff manually, you open yourself up to mistakes. You also open yourself up to being more emotional and trying to pick strikes based on your perceived level of income that you want to receive. And that's really where we see inconsistencies from this type of strategy. When you use automation like options play, you're going to get the same strategy every single time. We're always going to select a cover call that has roughly, that 30, 20, or 10 delta call for you so that you never deviate from that strategy. And that's how you gain consistency. Not only do we try to make this process as easy as possible for you, we make sure that you stick to the strategy that you intend to. So that's really how we built this tool from the ground up to make your life as easy as possible so that you have all the starting points that you need, all the analytics behind to make a decision, and lastly, how to go about placing this trade as easily as possible. Clicking on the trade button, we give you all the details to enter this trade into your broker's platform. So this is all designed to make your life as easy as possible. So lastly, what I just want to do is I'm going to jump back to the slide. I just want to cover exit strategies. Once you're in a cover call, there's basically 3 scenarios that you'll find yourself across and how to handle each one. So first of all, if you buy that Apple stock at 170 and the stock shoots up, what do you do? So first of all, the best thing to do when the stock shoots up and you see a large unrealized loss on that short call that you sold, the best thing to do is, number one, don't panic. You want to hold onto your position, and you only want to roll that position if you need to in the last week prior to expiration. What I mean by that when we talk about roll is to simply buy back the call that you've sold and sell a new one, because you can continuously do this over and over again and generate income. You actually don't necessarily need to lose your stock. You can always buy back that call and sell a new one. But if you're going to do that, you should only do that within the last week. You should never do that early. If you do it early, then you're effectively locking in a loss for your trade, and you don't want to do that. So those are some of the reasons. So those are some of the ways to handle a stock that shoots up after you've sold the cover call. In the second scenario, if the stock moves sideways, so you buy the stock at 170, you sell that 185 call, and the stock just trades sideways. It stays around 170. This is kind of your best case scenario. You just want to hold that position to expiration, let that call expire, and do it all over again. Lastly, you might buy that stock at 170, sell that 185 call, and the stock plummets down to 160, 150. This is the only time where it makes sense to roll your cover call early, meaning buy back that 185 call. If you sold it for $3, you'll probably be able to buy it back for a fraction of that. And the rule of thumb is that as long as you can buy back your call at 20% of the original premium that you sold it for, that's a good time to buy back that call and sell another one. So if you sold that call for $3 and you can buy it back at 60 cents or less, you want to take profit on that short call and sell another one for $3. And hopefully now you've reduced your cost basis by $5 or $6 by this point, so that even though you've taken a $10 loss on the stock, you've now recovered $5 or $6 back by selling covered calls. And hopefully that stock recovers a bit in the future, and you're able to come out net positive on the whole strategy. So that's the goal of selling covered calls. And that's just a quick overview of what the strategy is, how to go about thinking about it, why you should utilize it for your strategy, and most importantly, how can you use options play to actually help you find these strategies as quickly as possible. So like I said, I advocate that everyone sets up a watch list with the stocks that you own in your portfolio. And what we do is we provide you with the tools to quickly allow you to scan for the cover call and short put opportunities on those individual names, and allow you to figure out exactly how much yield you have and whether or not it's suitable for your portfolio. So with that, I want to thank everyone for taking the time out this afternoon. I apologize for the technical hiccup we had in the middle of the webinar. So please, at this point, if you have any questions regarding anything we just spoke about, please type them into the chat window or the Q&A window, and I'll answer as many questions as I have time for here today. So it looks like I have a question here using CGC as an example. So let's take a look at that. So CGC is certainly a high-flying stock, so I expect this to have a fair amount of volatility. So this is taking a look at the January 4th 36 cover call. This is based on my personalized settings, which I said is short-term optimal. Those are my settings. You can always pull up your own settings. So for example, if you were a short-term conservative, you would have chosen a 38.5. If you're aggressive, it would have picked a 34. And you can see the full matrix of availability here. So if you want to do longer dated options or more aggressive or more conservative, it's all available to you here under the options grid. So you can always make minor adjustments after the fact. So I'm glad you guys brought up this example because sometimes for certain stocks, maybe you have a different target price, or maybe you want to go a little further out. You want to make minor adjustments, but you don't want to pull up that whole option chain. Our tool really allows you to look at all the different availability by looking at the different expirations and strike prices just on an options grid. So that's how, that's just an example of using CGC. Ron's saying, in the future, can you develop a webinar that provides the best practices and techniques used for rolling an option to prevent assignment? I don't know that necessarily needs a whole webinar because rolling is very simple. You've sold the cover call already. So a roll is simply buying back the call that you already sold and coming into options play. So let's say you sold CG. Let's go back to Apple real quick. Let's say I sell the 185 call on Apple in January, or 182.5, whatever that is. And by January expiration, the stock's at 185. So what do I have to do? I have to buy back the existing call I have, and I come back to options play, and options play will tell me what to roll it to, because whatever new option that you get in January, that's the one that you want to roll it to. So it's really simple, just closing your existing position and rolling it to the new one, which is spit out at that time. So I obviously don't know where Apple will be in the future and what the new cover call will be, but options play will actually tell you what to roll it to. So if, let's say, I have an Apple call that's expiring today that I have or tomorrow, and it's at 170, then I would simply buy back that call and I would sell the January 4th 182.5 cover call. That's how you roll a cover call. It's really simple. You're just taking the new cover call that options play is spitting out for you, and you roll it to that by closing out the existing call that you already have. So I hope that answers your question as to how to roll, because that's all it is. It's closing out your existing position and figuring out what is the new cover call to sell on top of that, which you will use options play in the future to tell you what is the new cover call to sell. Are the slides available for download? Yes. So the slides will be sent to you right after the webinar with the recording. What income settings do you personally set? So like I said, my personalized settings are short-term and optimal. But that's based on my frequency of trading and what my risk tolerance is. Each one of you are a little different. So make sure you set your own risk tolerances based on your personalized settings. So Richard's asking a really good question. All of your examples show a cost near the current close. How about costs that are way underwater? Will the recommendations adjust both strike and expiration? So it won't adjust the strike and expiration based on the fact that you're underwater. And the fact that you're underwater is not a problem. You can still sell cover calls. Just understand that you do have the risk of ending up selling your stock at a lower than your cost basis. However, that's really why I advocate selling cover calls the second you own a stock. The second you own a stock, you should be starting to sell cover calls so that you don't find yourself in the position of only selling cover calls when you're way underwater on a stock. When you buy a stock, you should think about selling cover calls immediately on that, because that starts to offset your cost basis so that as the stock sinks, you're able to recover some of that back by selling cover calls. But like I said, just because the stock is underwater does not prevent you from selling cover calls. You would still use the same expiration and strike prices regardless of what your cost basis is. What do you do in a declining market when cover call premiums are not enough to cover decrease in stock price? So keep in mind, this is not meant to cover all the losses on a stock if the stock is declining. And your biggest risk is still the stock that you own. This is just meant to provide an income stream on the stocks that you own. If the stock is declining, your best thing to prevent further losses is to get out of that stock. There's no ifs and buts about that. If you own a stock and it's declining and it's continuing declining, I recommend that you simply just cut the losses on the stock. Cover calls is not meant as a strategy to recuperate those losses. It's simply meant to augment an income stream on the assets that you already hold. Now, that income stream does provide a small buffer against a small decrease in the stock, but it's not meant to hedge your portfolio. If you really need to hedge a portfolio, buy a put option or just get out of the stock. In a Roth IRA, any change in aggressiveness? The only thing I'll talk about is in an IRA account is that, no, I wouldn't say that you would necessarily change anything in a Roth IRA, in my opinion. Would I use the same options play data to sell cover calls on positions that I'm long with options? Yes. So if you own instead of Apple stock, you own an Apple Leap, you would still sell the exact same cover calls as if you own the stock. There's no difference whether you replace the long position with the stock or a Leap. John's asking, what is the cost of this program? As per my first slide here, the cost of options play is $50 a month or $500 a year. Any other questions? Ron, I'm glad you found that helpful. Okay, so if there's no other questions, I just want to thank everyone for taking the time out this afternoon. I really appreciate you guys taking the time. I apologize for that technical glitch we had in the middle, but we will be back here next week. We have a very special webinar on Tuesday. I'm bringing Michael Coe, the anchor of CNBC and president of Optimize Advisors, to talk about the current market conditions, what we're seeing in the market, what strategies that we're looking at. You know, it's certainly been a very challenging, I would say, trading environment for most people over the last couple of months. So what we're here is we're just going to talk to a strategist, get some ideas, and you guys can submit your questions ahead of time, and we will answer your questions live on a very special webinar. That's on Tuesday, and we'll resume our regular scheduled webinars next Thursday as well. So Guillermo, if you have a question regarding other option strategies, please send me an email at info@optionsplay.com. Happy to answer those questions. I'm here. I prefer to just answer cover call questions here. John, yes, for Fidelity or Schwab users, please send me an email at info@optionsplay.com. I'm happy to answer those questions. But the answer to your question is yes. Where can I see delta on a cover call? Great question. So on a cover call, you can always click on the this to see the delta. But what we also do is here is probability of expiring worthless. So as you can see, there's an 83.31% chance of expiring worthless. That's really what you're looking for when you're looking at deltas. You're trying to get a sense for probability. So we already have the probabilities here for you, so that you don't necessarily even have to look at the deltas. Will Options Play platform enter trades directly into Fidelity? So that's not something that's in the cards right now. So unfortunately, that's not something that we plan on doing in the near future. So again, thanks so much for taking the time out this afternoon. I hope to see you guys on the webinar next Tuesday with Michael Coe. Otherwise, I will see you on our regularly scheduled webinar next Thursday. Have a great afternoon, and the webinar recording will be sent to you right afterwards with the slides. So have a great afternoon. I'll see you guys next week.